So in this part we're going to learn about conventions. The first one we have conventions of consistency. So this conventions of consistency, what it means consistency refers to using the same accounting principles, same accounting methods to do accounting over a period of time. That is what we call consistency. So consistency refers to having the same accounting principles and methods from year to year within a company. So why consistency is required? In order to ensure comparability, we need consistency. So accounting information we need to compare, right? We need to compare the information of one company with another company. So when the books of accounts means when the financial statements prepared by the company do not follow the rule of means do not have the rules and regulations on a consistent basis, then that doesn't ensure comparability. So consistency means that the same transactions have been treated in the same way this year, last year, and in the same financial statement of the current year can be compared with the preceding year. So without any erroneous conclusion being drawn from them. See, consistency facilitates in making a comparison without any error, because if a company have followed consistency convention, what happens, they follow the same transaction by using the same methods, same practices what they have followed during the year last year, then we can easily compare how the company has performed this year, how the company has performed last year. So this is the consistency convention. So we have three types of consistencies. One is vertical consistency, horizontal consistency, and third dimension consistency. First one, vertical consistency. So what is vertical consistency? See, vertical consistency basically it's about having the same accounting principles and using the same accounting principles, same methodologies, same techniques in the same financial statement, like in a particular year. Say for example, you are preparing your books of account for the year 22-23. Financial statements means we prepare profit and loss account, we prepare balance sheet. So depreciation we charge, right? Depreciation we charge if we follow straight line method and we have calculated the amount, and that amount we need to show in the profit and loss account along with the balance sheet. If you follow straight line method to show the value in the profit and loss account and written down value method to show the value in the balance sheet, then that is not consistency. If you follow the same method from profit and loss account to the balance sheet, same techniques you have used to charge depreciation in the profit and loss account and in the balance sheet, then that is what we call vertical consistency. Then we have horizontal consistency. What exactly horizontal consistency is? So horizontal consistency means using the same accounting techniques over a period of time. Means last year also I had used the same techniques, this year also I am using the same. That is what we call horizontal consistency. Then finally we have third dimension consistency. Third dimension consistency means the same accounting rules, procedures, principles adopted by one company against to another company. Means if in our economy we are having A, B, C, three companies. A company also follows the same accounting principles. B company also follows the same accounting principles. C company also follows same accounting principle. That is what we call third dimension consistency. Means between the companies or among the companies. Like if two companies are there, if both the companies are using same accounting principle, third dimension. More than two companies are there, still they are using the same accounting principles among the companies, then also third dimension consistency. Next we have, so the next conventions we have, that is conservatism. What is conservatism? So conservatism speaks about to be safe, because a business is we are running the business in a very highly uncertain environment, because a future we cannot predict. What today we are having may not be have tomorrow. So future is always uncertain. So the transaction recorded should not result the overstatement of asset or income. Therefore accountants prefer conservatism convention, where they anticipates for losses but not for profit. That is the conservatism rule. So conservatism, what it tells, you need to anticipate all your future losses. If losses happens, you have reserves. If losses do not happen, then the reserves will be your asset. If you anticipate profit, what happen futurely, if in case if in future you won't get the profit, then what happens, you had anticipated the profit and you have shown that I am supposed to get 100 rupees, but if you do not get 100 rupees, you are showing your profit is overstated, then you will be responsible to answer. So conservatism tells you to keep reserve for the losses but not for the profit. You need to anticipate the future losses which will happen to your organization but not the future profit. So this is the conservatism convention is. Say here I had quoted few examples. Look at here. Increase in the value of asset and any other anticipated gain normally not considered until they are realized on sale. See, example what here we are having, if the value of asset has been increased, like market value of land has been increased, you are holding land which you have purchased for 10 lakh, but right now its value is 15 lakh. So you cannot record 15 lakh until unless you get the value. Okay, that is what conservatism principle is. But losses, what it tells, for losses you need to anticipate the losses. Say for example, you estimated that your sales could be lower next year, then you need to anticipate the loss, decrease in the value of asset. Okay, here one example which I have quoted, anticipated the losses and decrease in the value of assets are normally recognized even before sales. Suppose in future you have anticipated there is a loss from the sale, then such a losses we need to show, the like bad debts we show, no, that is conservatism. Next we have, so these are also the examples for conservatism convention, where we inventories normally we record either at cost or net realizable value, whichever is lower. We prefer to write off the expenses against the revenue of particular year. So we make provision for the debts. We create provisions for any changes in the prices of goods and services. These are all the practices which we practice due to the concept of conservatism. So conservatism basically speaks about to keep reserves for the losses, not for the profit. So the next, when you keep reserves, okay, when you follow profit, when you follow conservatism convention and when you keep reserves, what happens, profit is not overstated, it is desirable, because this is the safe strategy to play. If you overstate the profit, if you do not get the profit, then you are responsible. So that's why it is not permitted to overstate the profit, neither understate the profit deliberately, but somehow, but the future losses you need to identify and you need to show in the books of account. That is conservatism convention speaks about. Next convention we are having is materiality. So materiality, as in the last class, in our regular classes I told you, materiality means when an information is useful, then that information we call it as material information. So materiality is how an information can be called as a material, differs from one to another depending on the users. Okay, if I am an employee, for me the material information is the company's profitability, because from that I get to know whether the company will operate in future, whether I have the job, whether I will get the good salary for my job, and all estimation will happen to an employee. For an employee, dividend information is not required, because dividend information is required by the shareholders. Therefore dividend information will be a material information to the shareholder, not to an employee. So companies have a large information. The companies is not required to report all the information. They have to report the information which is very much useful to the users. That usefulness we call it as material. So what is material? Which is not defined lucidly, because it is a relative one. Say for example, whole, we can show 10 rupees 520.4 approximately as 10,520 rupees. So 0.4 do not have that much implication. If 10,500 519, and if you show 10,500, then 19 rupees difference we cannot show. That will be a material information. Point 0.4 rounding off do not have much impact, but 19 rupees rounding off have an impact. So that is what material is. So here already I told you this example. Moving to the next slide. uh, Here Horngren and the AAA committee, they have defined materiality means what? An item is material if its omission or misstatement would tend to mislead the users of financial statements under consideration. So Horngren, he defines what is materiality. Means materiality is defined with its importance. If an item of financial statement, if you have not stated, and that item which have missed, which have not reported, may possibly mislead the users, because that information possibly are very important information which is required by the users, but you have not stated such a information, we call it as material. So here AAA committee also defined materiality. An item should be regarded as a material if there is a reason to believe that knowledge of it would influence the decision of an informed investor. So when an information is called as a material information, when that information have an influence on the decision making activity of the users. Say for example, I am a shareholder, I want to invest, okay. If basically I invest in a company based on the information, how the company is performing, what is the profitability of the company over the years. If such a information has been communicated to me, that is what we call it as material information, because that information is having greater influence on my decision. If I get to know that the company is performing good and have a profit history, then certainly I invest in that company. Don't you think? That is materiality. So hence information which is useful, which is very much important, which have the impact on the users to take up their financial decisions or economic decision, such information we call it as material information, and that material information has to be reported in the books of account. Moving to the concept of disclosure. Disclosure means what information should be disclosed. See, when we prepare our books of account, there comes three questions. To whom we are reporting? To whom we are reporting? We are reporting to the internal parties and external parties. When we are supposed to report? When we are supposed to report? By the end of the accounting year, right? For a period of 12 months or for a period of particular interim report means we need to prepare at the end of 3 months. Like, but what should be reported? That is what disclosure is about. So here we can see what we need to disclose. We need to disclose the complete information about the company's performance, and apart from that, adequate disclosures which covers all the relevant information which is material, and all the accounting policies which have the company followed, and all the information as stated by the Accounting Standards and Companies Act 2013. All these information we have to disclose to the users. That is about the disclosure. Now moving to the accounting policies. What exactly accounting policies? It refers to the specific accounting principles and methods of applying those principles which is adopted by the enterprises in the preparation and presentation of financial statements. We call it as accounting policies. Nothing but for doing accounting, what are all the principles or what are all the methods that the company has adopted, that is what we call accounting policies. So when a company is selecting a particular accounting policy, like for depreciation purpose, which method they are applying, say for example, to evaluate the inventory, which method they are applying, for recognition of revenue, means for recognition of revenue, yes, which principle they are applying. These are all what we call accounting policies. While selecting such a principles and policies, the company should give importance to three things. One is prudence, substance over form, and materiality. So these are the three principles which governs the selection of accounting policy. If a company is selecting a particular accounting policy, then that company have to have a focus, have to consider three principles. What are those? Prudence, substance over form, materiality. Yes, sir. So, what is prudence? It refers to the concept where the reporting entities requires to exercise caution while adopting accounting policies and making estimates. This is necessary to ensure that assets and incomes are not overstated and the liabilities and expenses are not understated. So, prudence basically refers to when a company is adopting a accounting policy or when a company is selecting a particular accounting policy, then they need to be careful regarding that. So say for example, if the company decided to create reserves, then in order to create reserves, the company cannot go for overstating the profit and understating the loss, means expenses. If they do so, what happens? If they overstate the profit amount they will show higher, and out of profit they keep reserves, but in reality their profit is not higher. So that is prudence, means you need to be careful. You need to be careful while creating reserves or while selecting any policy. You need to be careful. That is what a prudence is. You need to pass, you need to have a proper judgment. You should not go for overestimation, you should not go for underestimation. You need to have a proper judgment to estimate for a particular thing while selecting a particular policy. That is prudence. The next one we are having is substance over form. So what is substance over form? So it refers to the concept which indicates economic substance of the transaction is very much important, and that has to be recorded in the financial statements rather than mere legal formality. This is necessary to present a true fair view of the company's affairs. See, substance over form already I explained you also. Somehow here substance over form refers to a company. Okay, now they have to record the transaction when they are having economic substance from that transaction. For example, if you have purchased a vehicle, okay, and the vehicle you have purchased on an installment basis, and by the end of accounting year you have not paid full installments, but still you have paid two installments, then you need to show the value of those installment paid along with your asset value in your books of accounts. That is substance over form. Even though that machine or that vehicle becomes yours legally after the payment of final installment, but somehow there is a economic substance which is there in the transaction, so you need to record that. That is substance over formality. So when you select a particular accounting policy or accounting guide, means any method, then you need to give importance to the economic substance over legal formality. This is substance over form. And finally here one more principle for selection of accounting policy, we have materiality. So when you are selecting a accounting policy, then you need to give importance to the materiality aspect, where all the financial information which is essential, which is required, which have influence on taking decisions, then such information has to be communicated. That is the concept of materiality. It indicates that the financial statement should disclose all the items which are material enough to undertake evaluation or to take decisions. So if a decision I need to take and the decision is depending on the information supplied by the company, then such a information has to be supplied. So when a company using a particular accounting policy, then they need to keep in mind whether they are serving the principle of materiality. So this is a materiality concept, means materiality principle which comes under accounting policies. So moving to GAAPs in recent year. So in recent year, now we do not, means we do have GAAPs, because if the companies are not following IFRS and Ind AS, then those companies are following generally accepted accounting principles. So at present, these GAAPs are in the form of accounting standards, are also in the form of international financial reporting standards and in the form of Ind AS in our country. So over a period of time, as the international financial reporting standards have been developed, which we call in our country as Indian accounting standards, so gaps we can see, we can witness in these forms.